Profits are the last but not least of our 3 key secrets for attracting and commanding top dollar from investors. Profits not only mean that you're making money or you're poised to make money, but that your books and records are accurate and reliable. Profits are the final puzzle piece that fits together with people and paper to complete your investor package. Now, profit does not necessarily mean that you're making money today. In fact, many startups and companies that attract investors are actually losing money. However, they have valuations in the hundreds of millions, if not billions, because their products are number 1 in their category or geographic area. This is an area where hiring a fractional CFO with experience in your industry can be vitally important to your business in a way that your bookkeeper just cannot. They can help you determine profitability for every single product or service you sell, analyze your expenses, identify places where you can cut out unnecessary costs, and streamline your operations as much as possible to grow that bottom line. They can also help you conduct market studies to determine emerging trends and whether or not you should launch a new product category or significantly expand, whether vertical integration makes sense for you, whether you should enter a new geographic area, and whether to invest capital in things like building or expanding your own facility versus using contract facilities. I understand that as entrepreneurs, we're used to figuring things out on our own and finding the solutions to our problems. However, when you lean on strong experts, you are allowing yourself more time in your life to focus on the areas where you can do the highest and best good. And those are usually your products and services and your brand. So, you can either spend $5,000 having a CFO help you analyze the marketplace and make the right decisions on these essential matters, or dive right in and spend hundreds of thousands of dollars to learn those lessons the hard way and drive away potential investors. Now, it's important to add here that if the overall size of your market is small, investors probably aren't going to want to invest no matter how great your people, paper, and profits are. That's because VCs are looking for markets with big growth potential. So, you need to have research in your back pocket that demonstrates the overall size of your market category, also which is known as your top-down market, as well as statistics on your bottom-up market, which is the total number of target customers multiplied by the average each one will pay for your product or service. Investors need both of these markets to be big enough to be worth their while and eventually provide a return on their investment. Leading investors in early-stage companies typically don't invest unless the total market size is 100 million at the minimum. Many will even want to see a closer to 500 million or a billion size market. Market size is important, but so is your growth rate. Depending on the industry, you may not even need to be profitable yet. Still, you will need to show investors that there's significant growth potential. And we're talking a hockey-style stick revenue curve with a dramatic upside ahead. Your company's product or service might not be profitable right now, but VCs want to see that you have a competitive advantage in the market in terms of quality, pricing, growth rate, cost structure, and market share. And you're approaching that hockey stick inflection point of your growth curve. With all of this information in your back pocket, When a potential investor starts asking hard questions about the market size, growth potential, and your financial decisions, you can easily answer them and present the hard data supporting your choices. You will look like a rock star, investors will be impressed, and that will show in the dollars and valuation they present to you.